Ever feel like you need a huge pile of cash or some kind of secret finance degree just to get started with investing? Well, today we're going to pull back the curtain on something called collective investments. Turns out it's the secret weapon for most everyday investors. So let's dive right in. Okay, so you did the hard part, right? You saved up some cash. Let's say it's $1,000. The million-dollar question is, what do you do now? Do you just pick a big, famous company you like and buy a couple of shares? You could, but that idea leads us straight into the first major hurdle for pretty much every new investor.
And that problem is really simple. For an individual, with $1,000, trying to go it alone in the stock market is just incredibly difficult, and frankly, it's super risky. Here's exactly why. Buying shares in just one company, say Apple, is called direct investing. And yeah, it's exciting, but it's also a bit like betting your entire savings on one horse in a race. To really protect your money, what you need is a diversified portfolio. That means a healthy mix of a whole bunch of different companies. The problem? Building that, one stock at a time, requires a ton of capital. I mean, just look at the difference here. When you're on your own, you are getting slammed with high trading fees for every little purchase. All your risk is packed into just a few companies, and you're limited to only a handful of shares. But when you pool your money with other investors, the entire game changes. Suddenly, costs plummet, risk gets spread way out, and you have access to this huge range of assets you couldn't touch before. So this idea of pooling your resources, it's not just an idea. It is the solution. It's a simple but honestly brilliant concept that completely leveled the playing field for people like you and me. It's officially called a collective investment scheme, or CIS. I know, it's a fancy name for a really simple idea. A fund takes money from thousands of different investors, just like you, and then uses that one giant pool of cash to buy a huge variety of investments. You've almost certainly heard of them, right? Mutual funds, investment funds, they're all based on this exact same powerful concept. And the benefits are just massive. You know those high fees we were talking about? They get slashed because of something called economies of scale. That huge risk of being tied to just one company's fate, poof, you're now diversified across dozens, even hundreds of them. On top of that, you get a professional manager running the show, you get access to markets you could never reach on your own, and you get the safety net of regulatory oversight. It's a win-win-win. Let's make this real. Imagine you have $3,000 and you want to build that diversified portfolio with, say, 30 different stocks. Well, with a pretty typical $10 commission per trade, you'd spend $300 on fees alone. That is 10% of your investment, just gone right out of the gate. In a collective fund, that cost is shared by thousands of people, making it practically nothing for you.
Okay, so this whole idea of pooling money, it's a global phenomenon. But as you'd probably guess, different parts of the world have their own names and their own rules for how it all works. So in the US, you'll almost always hear mutual fund. Hop over to continental Europe, and you might see something called a SICAV. And in the UK, they're usually called unit trusts or OAICs. Don't let the alphabet soup scare you. The core concept of pooling money is exactly the same no matter where you are. Now, one acronym that's actually worth knowing is UCITS. It's an EU regulatory framework that has pretty much become the global gold standard for quality and safety. So if you see a fund is UCITS compliant, just think of it as a stamp of approval that says this is a well-regulated, investor-friendly fund. It's a brand that's trusted all over the world. All right, so you get the basic idea. All these different funds, no matter what they're called, they generally fall into one of two main buckets based on how they're built. This is the first really big distinction you're going to encounter. Okay, on one side, you've got open-ended funds. Think of most mutual funds. Their door is always open. They can literally create brand new shares for new investors. You buy them directly from the fund company, and the price is based on the actual real-time value of their investments. Then, on the other side, you have closed-ended funds. They issue a fixed number of shares when they launch, and that's it. No more are created. Those shares then trade on the stock exchange just like a share of Apple or Google, and their price is driven purely by supply and demand. Now, I just used a really key term there, NAV, or net asset value. All this means is the true underlying value of one single share in the fund. You just take the total value of everything the fund owns, subtract any debts, and divide it by the total number of shares. Think of it as the exact price for one perfect slice of the investment pie. And this is where those closed-ended funds get really interesting. Because their price is driven by the market, it can actually drift away from their NAV. If a fund is super popular, it might trade at a premium, meaning its stock price is actually higher than the value of its assets. But, and this is the cool part, if it's out of favor, it could trade at a discount, which gives you the chance to buy a dollar's worth of assets for, let's say, 95 cents. Pretty neat, right?
So, we've talked about the structure of the fund, how it's actually built. Now, let's look at its investment strategy. How does the fund decide what to buy? This is another huge choice you'll have to make.
On one side, you've got active management. This is where you have a star fund manager and their team of analysts, constantly making calls, picking specific stocks, and trying to beat the overall market. You're paying for their brainpower and their expertise, and that usually means higher fees. On the other side is passive management. These funds don't try to be clever at all. They just automatically track a market index, like the S&P 500. You're basically buying the whole market for a very, very low cost. And the undisputed heavyweight champion of the passive investing world is the exchange-traded fund, or ETF. These things are brilliant. They give you all the diversification of a fund, but you can buy and sell them on a stock exchange all day long, just like a regular stock. So how does an ETF actually follow an index? Okay, let's slow down for a second, because this is really important. The first way is called full replication. It's simple. The fund just buys every single stock in the index it's tracking. Easy. The second is sampling, where it just buys a representative chunk of those stocks to mimic the whole thing. But then there's this third way, synthetic. Now listen up. Here, the ETF doesn't own any of the stocks. Instead, it makes a deal called a swap with a big investment bank. The bank promises to pay the ETF the exact return of the index. It's smart, it's efficient, but it introduces a whole new kind of risk. What happens if that bank goes bust and can't pay? That's called counterparty risk. Whew, we have covered a lot of ground. We've gone from the basic concept to fund structures and even their strategies. But there is one last absolutely critical thing you have to understand before you put a single dollar into any fund, and that is the fees. The main fee you're going to see everywhere is the annual management charge, or AMC. It's just a small percentage of your investment that you pay every year for the privilege of having them manage your money. Now, it might seem tiny, right? Maybe 1% or even way less, but trust me on this. Even a tiny fractional difference in that AMC can have a mind-bogglingly huge impact on your returns over the long run. So after all that, it really just boils down to this one fundamental choice. Do you pay more for an active manager hoping that you found a genius who can beat the market? Or do you pay as little as humanly possible for a passive fund, accept the market's return, and just ride the wave? That is the big question every single investor has to answer for themselves.